The global economy grew above expectations in 2018 but slowed in the second half of the year. The slower pace has continued into 2019, with the global outlook remaining reasonable but with increased downside risks. Trade tensions have caused continued uncertainty. Inflation rates have moved lower following the decline in oil prices and have since increased in a number of economies. China took steps to ease financing conditions in response to slower economic growth. Unemployment remains low and wages growth increased slightly. Long-term bond yields declined due to lower inflation expectations, while equity markets increased due to growth in corporate earnings. Domestically, economists have been discussing a slowdown in Australia. Gross domestic product results for December showed growth of just 0.2% for that quarter, dragging the annual growth for 2018 down to 2.3%. Housing prices continued to fall in Melbourne and Sydney. Lower housing values and reduced household consumption is providing further economic uncertainty. Short-term funding costs moderated and the Australian dollar remained steady. Forecasts suggest the Australian dollar will fall this year. The Reserve Bank of Australia reviewed their forecast of inflation down to 2% for 2019 and 2.25% for 2020, predominantly due to the impact of petrol prices. Low interest rates have continued to support the Australian economy, and while the RBA kept rates on hold at 1.5% in March, it's possible we'll see a reduction in rates in the 2019 calendar year. While economic growth in Australia is likely to remain slow, we're also likely to see policy stimulus in the upcoming April federal budget, with potential tax cuts and spending measures to support the economy through this difficult period. Looking at the Australian share market performance, the profit reporting season for ASX 200 stocks occurred in February, with the earning results to December 2018 indicating that corporate Australia is not doing as well as a year ago. This isn't surprising given the challenging economic environment. Companies reported profits, but only 50% of the companies reporting half-year results were able to lift profits. Overall, the aggregate statutory profits rose by 15.3%, but when we exclude results from key players Wesfarmers and BHP, profits fell by 5.5%. A positive result is that 83% of companies issued dividends. However, this is below the average of 86%. Overall, the outlook for resources remains strong. The housing slowdown is likely to impact building and retail industries, and companies will be focusing on reducing spending to maintain profits. Companies and investors will be interested in the impact of policy announcements in the April federal budget.